We've all assumed inflation is coming. Tariffs are rising, supply chains are shifting, commodities are tightening. But months have passed, and inflation still hasn't surged. So what if the real reason inflation remains low has nothing to do with trade policy at all? What if it's something deeper? A force barely mentioned in public debate? Let's make it real. Imagine a regular person wins the lottery and gets 10 million. They buy a home, pay off debt, take their family on a dream vacation. They spend fast and wide. Now imagine a billionaire receives that same 10 million. They don't spend it. They invest it in stocks, bonds, real estate. Same money, different behavior, completely different impact on the economy. This is what's been happening globally for over 4 decades. And it may explain why inflation has stayed low, even after trillions in stimulus and years of money printing. Today on Global Notes by JP, we're following the money to uncover how wealth concentration may be hiding the true story of inflation. Let's connect the dots. Since 1980, stock markets have exploded. Bonds soared. Housing hit record highs. But inflation collapsed from nearly 17% in the 70s to under 3% globally by 2020. We didn't just beat inflation. We rewired how the system works. And that rewiring starts with one key shift: who controls the wealth. In 1980, the top 1% owned 28% of global wealth. Today, they own over 40%. And here's what matters: the rich don't spend money the way the rest do. They save, they invest. Meanwhile, middle and lower income households spend most of their income or go into debt. That difference reshapes the entire demand structure of the global economy. Economists track something called the velocity of money, how often each dollar gets spent. Since 1980, velocity has dropped sharply. And after 2008, it plunged. Why? Because most new income and wealth went to people who didn't need to spend it. So they parked it in stocks, bonds, or real estate. Less money circulated in the real economy. More got trapped in financial markets. And that's why we got asset booms, but no inflation at the grocery store. Economists Mian, Straub, and Sufi call this the saving glut of the rich. They found that the annual savings of the top 1% now rival global capital surpluses once blamed for low interest rates. That's trillions of dollars searching for a return. Not in factories, not in wages, but in financial assets. It's not just that the rich save more. It's that their savings never make it back to the everyday economy. After 2008, central banks printed trillions, but inflation didn't show up because the money never made it into household spending. It stayed in reserves or got funneled into stocks, bonds, and housing. That's why you saw record-breaking bull markets. While inflation stayed under 2%, it inflated Wall Street, not Main Street. And if you want to understand what happens when central banks finally disagree on how to handle inflation, watch our video. Waller versus Powell, the Fed rift that could shake global markets. Because Powell may not be in charge for much longer. And the next rate cut might come from someone who sees inflation very differently. Links in the description. Yes, globalization brought cheaper goods. Yes, tech lowered costs. Yes, aging populations saved more and spent less. But here's what inequality does. It amplifies all of those forces. It shifts income to people who save, which means weaker demand, lower wages, and less inflation pressure year after year. Here's the cycle we've been stuck in. Wealth flows to the rich. The rich invest, not spend. Asset prices go up. Consumer prices stay flat. Central banks keep rates low. Low rates push more money into assets. Inequality widens. The loop repeats. That's how we created a system where asset bubbles inflate again and again. But inflation barely moves. If wealth remains concentrated, and if demand remains weak, inflation will likely stay muted over the long run. But if governments start redistributing income, or if workers gain bargaining power, or if public investment becomes the new normal, we could enter a new inflation era. The structure of demand is everything. Because it's not just how much money gets printed, it's who gets it and what they do with it. So the next time someone says, they printed trillions, why didn't inflation spike? Ask, who got the money? Because that one question explains decades of macro confusion. Here on Global Notes by JP, we don't just chase the headlines. We connect the dots, we decode systems, and we follow the money all the way to its impact. If you found this valuable, like the video, drop a comment and subscribe. Most finance channels give you the what. We give you the why and what it means for the future.